Hey guys, we are going to jump right into our weekly market update. Hope you guys are doing well. Please keep sending those questions over. We get a lot of people sending questions. I love it. Keep doing that. Check us out on social media. Make sure to share this with somebody and like our content. Hopefully you like it. Hopefully you can share it with somebody else that may be able to get some benefit out of it. All right, so we're going to jump right into the housing market, and we ended the year with one of the record number of sales for the whole country and the lowest number of sales, but we ended up at all-time high prices. Why? Inventory is low, supply and demand, just like anything else. So we see the housing market in this Business Insider. Housing market will take off in 2024. Renaissance is construction demand are set to surge. National Association of Home Builders CEO says so. They're basically ramping up their production because they know they need to fill this gap of not enough homes. And that's really where our supply, in reality, most of it is going to come from, obviously, because somebody sells a house. Typically, they're going to buy a house. So that kind of cancels each other out. Maybe different, move up, move down, or whatever, or a lateral move, but it cancels each other out. So where the actual new, fresh inventory is coming is from new home builders. And they are going to be Oh, sorry about that. They are going to be ramping up their production, and they have a great outlook for this. They're seeing a lot more in the way of people coming through their model homes, people getting set up on pre-approvals, people taking advantage of some of the concessions and the rate buy downs that they're doing. So that's good news for home buyers as far as inventory is concerned. Are they going to be able to, get to the point where we get to balance or too much? Doesn't look like it, but they're going to try and keep up. We see a lot of that going on in the Phoenix area, just like a lot of places. So, you know, Fed to begin rate cut discussion, but avoid teeing first one up. Now, keep in mind, just like with anything, it's about messaging, right? So, what the Fed is trying to do this whole time, and they relate to the party, as we always say, but they're trying to use some old tactics very late in the game to destroy demand in order to tame inflation. But a lot of them, again, are attorneys, not economists, and they're living. A lot of these people are living in the 70s, and a lot of them are living still in the COVID era. So, people need to kind of move on from these things and kind of let the market breathe a little bit, okay? And the prices will kind of tame themselves through some of this, but hopefully we'll see them lower these rates. Their first meeting coming up is going to be January 30th, 31st. Um, the big thing to look for, and I mentioned this last week, the big thing to look for is, of course, their goal is this magical 2% that was set out there by Alan Greenspan back in the day. And that's the holy grail of their thinking. But the thing to look for is shelter costs because is just to kind of quote Barry Habib a lot. This is something that people miss a lot in all these discussions and these mainstream media things. And when you go back and look at what they predicted, they've been wrong for years and years and decades on a lot of this stuff. But the thing to look for is shelter costs because that makes up about 44 to 41% of inflation, which then affects the Fed rate, which then affects the bond market, which then indirectly affects the mortgage rates and mortgage-backed securities and the 10-year treasury and all that. So what we want to see is, right now, where rates are, we want to see that inflation come down, and it has. Obviously, we're like over 9%. Now we're just above two-ish. And that's what they're looking for. So their first meeting is at the end of the month. But when do they actually take that data? Well, they look at data in the past, and it goes by rent data, believe it or not. And it's not a really up to date as far as now and what's happening in rent data now. You need to take more of a blended rate, which they don't do on the rental market. So they're about 6 to 9 months, maybe even up to 12 months behind on what's really going on with the shelter costs. And that should, if they're doing what they should be doing, should show up around February or March at the latest as far as what they're reporting. So if they're doing what they're supposed to be doing and nothing comes out of left field, remember last year we had $2 trillion in extra spending that both sides agreed upon in our government to print more money. That created more inflation. That was one of the biggest things. And then this shelter cost thing is a big deal. But what's going on with housing anyway? I think what's happened is, and I'm going to really dig into this a little bit more in historical facts here, but and the now. But what's going on here is a lot of people, it's been almost 2 years of this nonsense with the Fed and stuff. So what we're looking at is people kind of, some people's pay getting caught up with the inflationary factors that are baked in, even though inflation has dropped. They're kind of getting used to these higher rates. And it's something that we're gonna look at because it's something that we might have to kind of come to terms with as an overall trend. It doesn't mean they're not going to go down, but as an overall trend, are we going to see 2 and 3% rates anytime soon, or maybe ever? Probably not anytime soon for sure. Okay, but you know, the pending home sales anyway are rising. Okay, the pending home sales are rising as they try and ramp up inventory. And as we saw all-time highs in pricing. So, the only thing that's really going to give here is we're not going to see what we want to see in inventory anytime soon either, for sure. We may get a little bit better, but nothing crazy. The silver tsunami thing is not a thing. But that is going to make a big difference as far as the number of people getting out there to buy and just kind of getting over this and getting used to this. And, basically coming to terms with the fact, I got to move. I can't wait anymore, or I want to move. I can't wait anymore. And they're just going to move. Or first time home buyers being like, well, this is the new normal. We got to suck it up and make it work. So, right now, where we are with the bond market, we're in the fours. We should be, again, about 1.5 points higher than that on mortgage rates, is what's typically the historical norm. So we should be in the mid fives. Now, I'm telling you, with new home builds, they're offering tons of incentives. Lower, I've seen rates as low as 3.9. I'm going to show you some prices on homes here in a bit that, these are in the mid fours for rates because they buy down these rates in bulk. And then they're offering closing costs. So you can get that now. But historically, when we see this right now, rates in the overall average for the retail rates, not the wholesale mortgage broker rates like we like to send our clients to, or at least give them the option of, you know, usually you're going to see right now those average rates should be about 5.5 or in the mid fives. And we're at 6.9. Why? Again, this taming of inflation, the higher, it costs more for investors to go in and buy these bonds and then securities. So that's what's causing this, along with, like we said, the infusion of more dollars. And then we had a little bit of a snafu with our banking crisis. So all that added together, along with lowering of the U.S. credit rating twice. And here's where we end up with all this nonsense that really is self-imposed. And we also went into the whole thing about energy. I brought out the article before. I don't have it up right now, but we're trying to go to a lot of this other alternative energy is costing money. Now, there's these tax credits, but that money has to come from somewhere to pay for these and subsidize this stuff. Another inflationary factor, guys. Okay. When you run on credit and you run on these, extra dollars for all these programs and stuff, those are inflationary factors. And that adds to this. Okay. So historically, what I'm asking people right now is, okay, if you're gonna wait, and you're not going to catch that wave of the next housing boom, regardless of where the rates are at right now. People are going out and buying homes. Okay, the numbers don't lie. We're seeing more pre-approvals, more traffic, more offers. By February, March, we're really going to get some really solid data on all this. And And I believe rates overall are going to trend in a downward direction. There's going to be some volatility because of this nonsense that I've been talking about with the Fed and the economy. And right now they're really, we don't know what we're going to do. But, a lot of people are thinking they're probably going to lower rates around 5 to 6 times this year total. We should start to see that break, like I said, around March, um, and in a big way again in around July, because of some economic factors that we talked about. But the thing that I want to kind of ask people is, okay, number one, housing's going up. So if you do you want someone else to gain the equity, on the home you want to buy? Most likely, you're not moving to a uh, less appealing place if you want to move there, or odds are anyway, right? You're not. In other words, you're not hurting yourself in quality of life. And a lot of this is about lifestyle, right, guys? Where you live, your home. It's about your lifestyle. We totally, you know, understand that here in the Mancola Group, and we understand things are not cheap. A lot of this inflation is baked in, even though it's gone down and all that. But a lot of this is baked in. We totally get it. And but where you live, your home is about your lifestyle. So we really want to be sure that you kind of get the full picture. So I just want to make sure people understand what they might be giving up, because if you move now, and let's say, like last year, people overall average gain, here in the Phoenix area was 6.4%. Okay. So let's just say your property goes up 25, $50,000. Let's say rates drop in the next, over the next year or two, and property values go up 50 to 100 grand. You're now not you're waiting, and you've lost out on those equity gains for the area, for the home, for the lifestyle that you wanted to go to. So it's just something to think about. Also, one other thing to think about is blended rate. So if you have other debt, okay, if you have other debt, and you take the blended interest rate of all your debt, credit cards, car loans, whatever, you look at that, and then you look at what the mortgage rate's going to be. Okay. And again, you can get lower rates now with our mortgage broker. I've seen rates in the last week or two in the fives with our mortgage broker. Okay. So the wholesale market is there. You can get rates in the fives now. That's with no buy down. That's with good credit, with approved credit. But also, you have these new home build options where they're covering closing costs, lower interest rates. Again, I've seen, anywhere's between the fours, to the fives, there. So there are options if you're open to kind of looking at that. And the third thing I would bring up is this. Historically, let's just take this decade here from 2000 to 2010. I tell people, oh, okay. Well, if you're not thinking about moving now, are you open to the idea of staying where you are for the next 10 years? They're like, what are you talking about, Chris? Or for the next 8 years? Let's throw in the last 2 years of nonsense from the Fed in there. And I say, well, what do you mean? Well, historically, when we kind of look back and even look back at some of these other years, but let's say from 2000 to 2010, look at that midpoint that runs through this right in there. That's right around from 2000 to 2010. You're running around right around a 6% interest rate, which is right around the historical average too. Okay. Around 6, 7% historical average. But let's just say, through this period right here between 2000 and 2010, we ran about 6% on average, up or down, but around 6%. That was for 10 years, 10 years, guys. So, what I say is, a lot of times, even if you look at some of these other, decades, they're kind of similar. There's not, you know what I mean? Like it kind of hovers around that same mark. Like if you look at 90 to 2000, look at that. It's hovering right around that 7.5 range. So, sometimes these cycles just kind of go that way. I just want to make people aware of these things. And again, what you're giving up in equity in the property you want to be in the lifestyle you want to have, you're giving up and giving to somebody else or letting them have it versus you. So just some food for thought out there on that. I made the move with the higher rates. and all that. I totally get the idea of waiting as a first thought, but think about those three things when you're looking at this, and really sit down with, hopefully with us and one of our mortgage brokers. You can check with your own people, your own bank, whatever, maybe somebody else you have on file. Check out the numbers, really look at the long game, okay, the now and the long game of what you may be stifling unnecessarily. Okay, unnecessarily. So this is the current inventory, 15, a little over 15,000. That's kind of been the same. No real big change there. Crawford Market Index. Now, one other thing I want to mention is the builders. We talked about the builders earlier. They are very excited about the housing market right now, and also in the Phoenix area, so are sellers. You know why I know that? We are right now at the highest average list price per square foot in our history. And that's at $370.84 per square foot right now. That's the average list price per square foot of active listings right now. So sellers are starting to get excited. Okay. But remember, sellers are usually buyers. In our market, again, we kind of went through this before, about 15, maybe 20% at the most are the investors and iBuyers and all that stuff. So, but sellers are certainly, you know, very excited about this right now. Also, we see getting into the Crawford Market Index. Where am I here? Oh, there we go. Um, so on the contract ratios, we want to look at the contract ratios. And for them, on the contract ratios from the Crawford report, they're showing over 40 on their index for contract ratios. Over 40 is a seller's market. Right now, we're at 42.5, 42.5. So mild, but a seller's market and trending higher. Okay. Um, just to give you an idea, at the highest point during the crazy time of 2021, we were as high as 287, and in part of 2021 into 2022, early 2022, or the first half, we were at about 258. So those are our peaks there, and the highest levels ever. But right now, on the Crawford Market Index, under 90 is a buyer's market, over 110 is a seller's market. Right now, we are at a 116. That's been creeping up, okay, every week. Our demand has been creeping up a little bit, nothing crazy, but still low. But so this puts us in a mild seller's market. We're over 110, so mild seller's market, just like the contract ratio show. And you know, the supply is kind of just hanging there, not really changing much. Okay. Um, but a few cities that have seen sharp rise in contract ratios over the past couple of weeks. Okay. Like super sharp rises. Apache Junction, 64% up. Okay. 64%. Um, they're at 94. Remember, over 40 on the contract ratio is a seller's market. They're at 94. Okay. Anthem up 47 point, I'm sorry, 47%. Say they're up to 71 on that index. Arizona City up 42% at 57. Gilbert up 46% to 65 on the index. Sun Lakes 45% up. Okay, these are sharp rises. Okay, 45% up to 59 over that 40 mark. Okay, so they're at 59. Chandler up 43% at 72. Tempe 31% at 53. Peoria up 31% to 49. And number 9 on the list is Gold Canyon, up 30% to 32. Okay. So these locations have the sharp rises. The ones kind of going backwards a little bit are Fountain Hills down 11%, Levine down 15%, Goodyear down 7%, and Sun City down 5%. Phoenix is up 18%. So this is a leading indicator of a change in the market. So you want to know when the shifts are happening, where they're happening. There you go. Okay. So those are going to be your hotter areas of town and what to expect there. When we look at, why, things are growing so much in the greater Phoenix area, we have to look at, mention this last week, I'm going to mention it one more time. Major projects. People are moving here. And we're number 4 in 2023 of where people move to because of we're leading the country in manufacturing. We've got Hershey going in right near where I live. There's the Taiwanese plant for semiconductor and the advanced chip design going in over there. All kinds of stuff going in here. It's crazy. Um, on the market index, we saw also, just as a quick note, last week we were up 10% for all the cities combined. We were up 10%. This week we're up 12.6%. Okay. And we're going into that, February, March buying spring frenzy that always happens, for us. Straight through May is kind of our busy time. This, starts our busy time. So we'll start seeing those contracts and solds going up right around March, April, February. I'm sorry, February, March, April, May, into June, and then summer's pretty busy, but things slow down a little bit because people kind of want to take their vacations and then start school back up in August. So it's just a matter of getting through that spring season, and it's so hot too in the summer that sometimes people just are like, okay, found the property, or want to get this done early and not have to deal with it during the hot weather. So that happens a lot. People do plan that way, big time here in the valley. Now, obviously, your retirement community, 55 and older, may be a little bit different, but that's the story. So, guys, if you have any other questions, please let us know. Also, please like, share, follow us. Hopefully, you find this content valuable, and check the links below in case you want a home evaluation, home search, pre-approval, any of that stuff, or just reach out to us and we'll get you started. All right, guys, we'll see you next time. Thanks.